Hello financial fans, welcome back to another stock analysis. Today we'll be covering Best Buy, stock ticker BBY. Best Buy is an electronics and appliances retailer. Currently they have 1,041 locations in the United States. Their market cap is currently sitting at just under $18 billion. In 2021 they generated the revenue of $51.76 billion. And their dividend yield is currently sitting at 4%, and their dividend yield is currently sitting at 4.39%. 43% of the revenue is generated from computing and phones, 31% from electronics, 16% from appliances, 5% for entertainment, and 5% from services. To calculate the final value of Best Buy, we'll be using a margin of safety in our calculation. This margin of safety will be based on financial ratios and the financial health of Best Buy. We'll be using a standard margin of safety of 25%. This margin of safety will be either decreased or increased by using a scale. When we're using 4 colors in our scale, bright red will mean 5% added to our margin of safety, orange will mean no change in our margin of safety, light green will mean 5% deduction from our margin of safety, and bright green will mean a 10% deduction from our margin of safety. When using 3 colors in our scale, bright red will mean 10% added to our margin of safety, orange will once again mean no change to our margin of safety, and bright green will mean 5% deduction from our margin of safety. First ratios that we're going to check out are the EBIT growth and the margin growth. As you can see, the EBIT has grown from almost 1.3 billion in 2013 to over 2.5 billion in 2021. During this period, the average growth was 9.6%. Looking at our scale, there is no change in our margin of safety. The margin has steadily increased over the years as well. During this period, the average margin growth was just under 8%, meaning a 5% deduction from our margin of safety. The next metrics that we'll be looking at are the dividend growth and the payout ratio. As you can see, the dividend has steadily increased from 58 cents annually per share in 2010 to $2.80 annually a share. The dividend has not decreased during these years, even though you might think it happened from 2016 to 2017. This is just because in 2015 and 2016, Best Buy paid out extra dividends on top of the regular quarterly dividends. During this period, the annual dividend growth rate was 80% on average. Looking at our scale, this is a 10% deduction from our margin of safety. The payout ratio is a nice 50-50 split. This is exactly in the middle of our scale, so once again, no change in our margin of safety. The final 2 metrics are the debt to equity and the return on invested capital. As you can see, the shareholders' equity is greater than the liabilities, which means the ratio will be below 1, which means a 5% deduction from our margin of safety. The return on invested capital for Best Buy is sitting at 17.13%, meaning a 5% deduction from our margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Best Buy. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow from 2012 all the way to 2021. During this time, the average growth was just under 40% every year. Since we're calculating the lifetime expected growth of Best Buy, I've gone with a conservative 10% of the average growth, which is just under 4%. Using this percentage, we can determine the future free cash flow of Best Buy and determine the terminal year of valuation. In doing this, we'll be using a perpetual growth rate of 2.5% and a discount rate of 9%. Then we get a sum of free cash flow of $41 billion and $495 million. To get our equity value, we have to add the cash and equivalents and subtract the total debt that Best Buy is bearing. Doing this, we get an equity value of $14.5 billion. To get our discounted cash flow price per share, we just have to divide it by the shares outstanding. Shares outstanding are currently 221 million shares. Doing this, we get a discounted cash flow price per share of $183.24. With the current price of $80.21, we get a whopping upside of $103.03, which is just under 130% upside. The next valuation model is the dividend discount model. I've imported the dividend payouts that Best Buy has done from 4 years ago to the current year. During this period, the average growth rate was 18.5%. Since we're once again doing the lifetime expected growth rates of dividends for Best Buy, I've gone with 25% of the growth rate, which is 4.63%. For this valuation, we'll also once again be using a discount rate of 9%. Doing the math, we get a discounted dividend price per share of $84.30. With the current price of $80.21, here we get an upside of $4.09, which is an upside just over 5%. The last valuation model that we'll be using is the multiple valuation. By looking at similar companies to Best Buy, looking at their stock price and their earnings per share, we'll get an average PE multiple of the industry. Then, multiplying it by the earnings per share that Best Buy is generating, we get a fair value. This fair value is $52.74. With the current price of $80.21, this is a downside of $27.47. It's just under a 35% downside. Let's look at the final overview of our valuation next. Looking at our final overview of valuation, we have imported the discounted cash flow price per share, the discounted dividend price per share, and the multiple valuation price per share. Out of this, we get an average of $106.76. Our margin of safety we have determined earlier, using a standard margin of safety of 25%, deducting 5% from the debt to equity, deducting 5% from the margin growth, deducting 5% from the return on invested capital, and deducting another 10% from the dividend growth, which leaves our margin of safety at 0. This means the fair value will be the same as the average, which is a fair value of $106.76. With the current price of $80.21, this leaves us with an upside of 33.1%. If you do not want to use this method of determining your margin of safety, we can just fill in 25% here, and then we would get a downside of 0.17%. So it would be around the current value. I hope you enjoyed the video. If you have any companies that you would like to see on this channel, please let me know in the comments. Thanks for watching.